So good day everyone. By the way, I am Winelyn Cortez and I am here to discuss my topic that is all about certificate of deposit, Eurodollar deposit, municipal notes, and variable rate demand notes. So first, let's talk about certificate of deposits. So a certificate of deposit or a CD is a bank obligation payable on a specific maturity date. So it's a type of bank obligation where investors deposit money for a fixed period and earn interest at a specified rate. So what are certificates of deposit? So a CD is a financial product offered by banks where an investor deposits money for a fixed period and the interest payments can be made periodically or at maturity along with the original principal. Unlike commercial paper or CP and repurchase agreements or repo markets, which are mainly used by institutions, CDs can be sold to both institutional and retail investors. Next, let's talk about the types of CDs. First is the retail CDs. It is for individual investors. So retail CDs are considered low-risk investments because they are insured by the Federal Deposit Insurance Corporation or the FDIC. So the FDIC guarantees up to $250,000 per depositor, per insured bank, or per account ownership category. So this makes CDs as safe as other US government-backed obligations. While FDIC insurance has limitations, if an individual deposits more than $250,000 in a single bank, the amount above this limit is not FDIC insured. Repayment of uninsured amounts depends on the bank's creditworthiness. So to ensure full FDIC coverage, investors can spread their deposits across multiple banks, each providing insurance up to the $250,000 limit. Second type of CDs is the brokered CDs. So these are the CDs that an individual investor purchases through a broker-dealer rather than directly from a bank. Despite being purchased from a broker, they function the same way as bank-issued CDs. So the FDIC insurance of brokered CDs are covered under the same $250,000 deposit insurance limit as CDs bought directly from banks. Typically, they are held in a broker-dealer account along with an investor's other securities. And also, brokered CDs may offer access to a wider variety of CD terms and rates from different banks. It has also potential risks of brokered CDs. It may not be as liquid, meaning selling them before maturity can be more complex. Third type of CDs is the institutional CDs. So these CDs are mainly for institution and high net worth individuals investing in amounts that exceed the FDIC insurance limit. So since FDIC only insures up to $250,000 per depositor per bank, larger investor must evaluate the creditworthiness of the bank before purchasing CDs beyond this limit. So, and also institutional CDs may risky if any amount above $250,000 is uninsured, meaning the investor bears the risk if the bank fails. Next, there are types of CDs based on issuing banks. So first is the domestic CDs. Domestic CDs, it is issued by US-based banks. These are standard CDs that may be FDIC insured, which is up to $250,000 per depositor or per bank. Second is the Yankee CDs. It is issued by US branches of foreign banks. For example, a CD issued by the New York branch of French bank, not FDIC insured, meaning there is a risk of losing money if the issuing bank defaults. Third is the Euro CDs. Euro CDs it is US dollar denominated CDs issued outside the United States. For example, a CD issued by the London branch of a Japanese bank, not FDIC insured, even if issued by a US bank's foreign branch. So these CDs are often used by international investors seeking US dollar exposure. So now let's proceed to discuss about Eurodollar deposits. Okay, which is Eurodollars deposits are US dollar deposits held at foreign banks or foreign branches of US banks. They are not subject to US banking regulations or oversight by the Federal Reserve. Also, Eurodollar deposit is not regulated by US authorities. It can be used by institutions to avoid certain US banking restrictions. And also, Eurodollar deposits are illiquid, means it cannot be easily sold and can only be redeemed early with a penalty. So the term Eurodollar deposits originally referred to US dollar deposits held in Europe, but today it applies to any US dollar denominated deposit held outside the United States. And also these deposits are commonly found in financial hubs like Europe, where it is originated. They can also be held at other offshore locations such as Cayman Islands, Bahamas, Bahrain, Canada, Hong Kong, Japan, Netherlands, Antilles, and Panama and Singapore. Despite their location, all such deposits are referred to as Eurodollars because they share the same characteristic. They are outside U.S. jurisdiction and not regulated by the Federal Reserve. Next discussion is about municipal notes and variable rate demand notes, which is municipal notes are short-term obligations issued by municipalities to meet cash flow borrowing needs. Municipal notes normally mature in a year or less and pay interest at maturity rather than through periodic payments. Municipal notes provide short-term borrowing solutions for local governments and are categorized by the expected revenue source, such as taxes, revenues, or bonds. So the most common types of municipal notes are tax anticipation notes, TANs, revenue anticipation notes, RANs, tax and revenue anticipation notes, TRANS, and bond anticipation notes or bonds. Now let's talk about the types of municipal notes. First is the tax anticipation notes or the TANs. Tax anticipation notes are issued in anticipation of future tax collections, such as property taxes. So these are used to bridge the gap between expenses and the collection of tax payments. For example, a city might issue TANs to cover payroll expenses while waiting for property tax collections. Second type is the revenue anticipation notes. So revenue anticipation notes are issued based on expected revenue from sources other than taxes, such as state aid or grants. Common among school districts that rely heavily on state funding. For example, a school district might issue grants while waiting for state education grants. And third is the tax and revenue anticipation notes. So tax and revenue anticipation notes are issued in anticipation of a combination of both taxes and other sources of revenue such as state aid. So it is a combination of TANs and RANs backed by both tax revenues and other sources like state aid. It offers greater flexibility to issuers with multiple revenue streams. For example, a city expecting both property tax and state transportation grants might issue the trans. Fourth is the bond anticipation notes. Bond anticipation notes are issued in anticipation of a future longer-term bond issuance. Bonds may very often be rolled over or refinanced before the issuer ultimately floats a bond issue. So it issued when a government plans to issue long-term bonds in the future but needs the cash now. For example, a city planning to build a new highway might issue bonds while preparing a large bond sale. Therefore, issuer access the bond market is the primary source of repayment. So all things being equal, the TANs, RANs, and TRANs are considered more creditworthy than the bonds. Since the payment of the former three types of notes is not contingent upon access to financial markets, and the revenues used to repay the notes is accessible. So there is additional details about municipal notes, which is TANs, RANs, and TRANs are considered cash flow notes or seasonal borrowing needs notes. So these instruments allow municipalities to meet various liquidity needs throughout the fiscal year. So they allow local governments to cover expenses until expected revenues, taxes or state aid or arrive. For example, a city expecting property tax revenue in December might issue TANs in July to cover operating costs. When analyzing municipal notes issuers, both Moody's and Standard and Poor's often designate special short-term ratings, taking into account questions such as the projected cash flow for the upcoming period and the sources, quality, and probability of the repayment. A municipality with strong tax revenues and reliable state funding will receive a higher short-term rating, reducing borrowing costs. So, lastly is the variable rate demand notes or the VRDNs. So, a variable rate demand note, VRDN, is a long-term tax exempt municipal bond. Maturities can be as long as 30 years. That is structured like a short-term security in that it has long-term maturity. It has a floating interest rate, meaning the rate adjusts periodically, which is daily, weekly, or monthly, based on a benchmark. The investor has a purchase demand feature, liquidity option, allowing them to sell or put the note back to the issuer or a liquidity provider on demand, usually with 7-day notice. So these bonds are commonly issued to fund public infrastructure and development projects such as industrial development. For example, for this is factories, business parks, pollution control, example, environmental cleanup, education, example, school construction, housing, example, affordable housing and initiatives, healthcare, example, new hospitals, clinics, and transportation. So example of transportation is highways, bridges, airports. VRDNs are typically issued through a quasi and governmental agency such as a development authority, but the ultimate debt responsibility belongs to the private entity using the funds. So the role of remarketing agents are financial institutions such as investment banks or broker-dealers responsible for managing the buying and selling of VRDNs in the secondary market. So their key role is to remarket the VRDNs when an investor decides to sell or put the bond back. To, to ensure liquidity, the remarketing agent adjusts the coupon or the interest rate at regular intervals, which is daily or weekly. So the goal is to match supply and demand, ensuring that the bond remains attractive and sells at par value, which is $1,000 per bond. So how the coupon rate adjustment works? First, if demand for VRDNs is high, the remarketing agent lowers the interest rate since investors are willing to buy at a lower yield. Second, if demand is low, the agent raises the interest rate to attract buyers. Third, this process ensures that VRDNs maintain liquidity, allowing investors to exit their positions without price fluctuations. That's the end of my discussion. Thank you for listening.